This morning, Xi Jinping looked across the table at Donald Trump in the Great Hall of the People in Beijing and asked a question that has determined the fate of empires for 2,500 years. He asked whether the United States and China could avoid the Thucydides trap. That question is not rhetorical. It is not diplomatic theater. It is the most precise description of the structural dynamic that I have been studying for 50 years, applied to the most consequential geopolitical rivalry of our lifetime. And I want to show you something that almost nobody covering today's summit is connecting to it. In every single historical instance where a rising power has challenged the dominant monetary order of its era, one asset has performed better than every other asset class in every other category, without exception, across 500 years of recorded power transitions. Write this down, because what happened in Beijing this morning is not a trade story. It is not an Iran story. It is not a tariff story. It is the opening move of a monetary transition that the long-term debt cycle framework I have spent 50 years developing tells me is already well underway. And the investors who understand what the Thucydides trap means for the monetary system are not watching the summit press conference. They are watching gold. Subscribe now. Let me start with what the Thucydides trap actually is, because most of the coverage today is treating it as a historical curiosity rather than a structural framework with direct and measurable consequences for every asset you own. The phrase comes from the ancient historian Thucydides, who documented the war between Athens and Sparta in the 5th century BC. He wrote that it was the rise of Athens and the fear that this instilled in Sparta that made war inevitable. Political scientist Graham Allison at Harvard identified this same pattern in 16 major power transitions over the past 500 years. In 12 of those 16 cases, the transition produced war, not skirmishes, not trade disputes, war. The structural dynamic is always the same. A rising power accumulates economic, military, and technological capability that begins to challenge the dominant power's position. The dominant power, watching its relative advantage erode, responds with fear, restriction, and escalation. The rising power, sensing that its window of opportunity may close before it consolidates its gains, responds with assertiveness that the dominant power reads as aggression. The cycle of fear and miscalculation produces outcomes that neither side wanted when the cycle began. Now here is what Allison's framework leaves out, and what I have spent 50 years studying in the context of debt cycles and monetary transitions. Every Thucydides trap in recorded history has had a monetary dimension that preceded and in many cases drove the military conflict. The transition from Dutch to British dominance in the 17th century, the transition from British to American dominance in the 20th century, the current US-China rivalry. In every case, the question of which power controlled the world's reserve currency, the asset in which global trade was denominated and global savings were stored, was the deepest and most consequential dimension of the transition. And in every case, the period of greatest uncertainty about which power would ultimately prevail, the period when the transition was underway but incomplete, was the period in which gold performed best of all. I want to be precise about the monetary mechanism that connects the Thucydides trap to gold, because this is the connection that the summit coverage is entirely missing. The dominant power in any era controls the world's reserve currency. That control is not merely a financial privilege. It is the source of structural power that funds military capability, finances fiscal deficits, and allows the dominant power to consume more than it produces indefinitely, because the rest of the world must hold its currency as a store of value. The United States has enjoyed this privilege since Bretton Woods in 1944. It has allowed America to run the world's largest fiscal deficits, accumulate $39 trillion in national debt, and pay for its military, its entitlements, and its infrastructure by issuing bonds that the world was obligated to buy because it needed dollars to conduct global trade. China's challenge to this arrangement is not primarily military, it is monetary. China has been systematically building the infrastructure of an alternative monetary system for over a decade. The Belt and Road Initiative, which has extended Chinese financial relationships to over 150 countries. The cross-border interbank payment system, which processes international transactions in yuan outside the SWIFT network that Washington controls. The Shanghai Gold Exchange, which prices gold in yuan and has established China as the world's largest physical gold market. The People's Bank of China's gold accumulation program, which has added hundreds of tons to China's official reserves over the past 3 years. And most consequentially, the February 2022 demonstration when Washington froze $300 billion in Russian central bank reserves with a keystroke that dollar-denominated assets held outside American jurisdiction are not safe from American power. China watched that event with the same attention that every finance ministry and central bank in the developing world gave it. And China drew the same conclusion. The dollar's reserve currency status is inseparable from American willingness to use it as a weapon. That is not a feature of the dollar system that China is willing to remain dependent on. Now, I want to show you the historical record of what gold does during Thucydides Trap transitions, because the historical record is the most honest framework I have found in 50 years of studying these cycles. And the record on this specific question is unambiguous. During the transition from Dutch to British monetary dominance in the late 17th and early 18th century, the Dutch guilder, which had been the world's reserve currency for over a century, slowly lost its monetary primacy as Amsterdam's trade and financial dominance was challenged by London. Gold, which was the ultimate settlement asset underneath both the guilder and sterling systems, held its value through the transition while the paper currencies of both powers experienced significant debasement. The investors who held gold through the Dutch-British transition preserved their wealth across the monetary shift. Those who held guilders found their savings repriced as the Dutch monetary system lost its global primacy. During the transition from British to American monetary dominance in the early 20th century, gold performed the same function. The period from 1914 to 1944, the 30 years during which it was genuinely uncertain whether Britain or America would emerge as the dominant monetary power, was precisely the period when holding gold rather than either sterling or dollars provided the most reliable preservation of purchasing power. Bretton Woods in 1944 formalized American monetary dominance. But the investors who held gold through the uncertainty of the transition did not need Bretton Woods to tell them the outcome. They had already been protected by the asset that existed outside both competing monetary systems simultaneously. Now apply that framework to 2026. The transition between American and Chinese monetary influence is not complete. It may take decades to complete, but the transition is underway. Central banks have confirmed it by purchasing gold at double the historical average for 3 consecutive years. Gold overtaking U.S. Treasuries as the largest reserve asset in global central bank portfolios has confirmed it. And Xi Jinping asking Trump whether they can avoid the Thucydides trap on the first morning of their Beijing summit has confirmed it in language that any serious student of monetary history can read clearly. We are inside a Thucydides trap transition. We are in the period when it is genuinely uncertain which power will ultimately define the global monetary order of the next century. And that uncertainty is precisely the environment in which gold has outperformed every other asset class in every previous instance of this pattern. I want to address the question I know many investors are asking right now. If this is true, why is gold sitting at $4,700 rather than at its January high of $5,589? Why is gold not already reflecting the magnitude of the structural transition I am describing? The answer is the same answer I have given in every major gold correction I have watched in 50 years. The short-term price and the structural price are different things. The short-term price of gold right now is being suppressed by three mechanical factors. The dollar has strengthened as the Iran war has driven oil above $100, creating emergency petrodollar demand. The Federal Reserve has been forced to hold rates elevated against 3.8% inflation, keeping nominal yields high and the opportunity cost of holding gold elevated. And the speculative positioning built up during gold's run to 5,500 has been partially unwound as the mechanical headwinds reasserted themselves. All three of those factors are temporary. They are tied to the specific geopolitical configuration created by the Iran war. They are not the structural drivers of the long-term monetary transition I am describing. The structural drivers, the central bank accumulation, the de-dollarization of global reserves, the construction of alternative monetary infrastructure by China, the fiscal arithmetic of $39 trillion in American debt that makes monetary accommodation of inflation eventually inevitable, those drivers have not changed. They have intensified. And the Thucydides Trap dynamic that Xi named this morning in Beijing is the meta-framework that encompasses all of them. The transition from American to Chinese monetary influence does not require a war to produce its consequences for gold. It requires only the sustained uncertainty about which power will ultimately define the global monetary order. And that uncertainty is now being conducted openly at the highest diplomatic level in the Great Hall of the People in Beijing. There are two types of investors watching today's Beijing summit. The first type is watching for a tariff announcement, a Boeing aircraft deal, a rare earth agreement, a joint statement on Iran. They are watching the surface of the summit. They are watching the trade negotiations that will determine whether Apple's supply chain gets a 6-month extension and whether American farmers can sell more soybeans to Chinese buyers. Those outcomes matter. They matter for stocks, for bonds, for specific sectors. But they do not change the structural dynamic that Xi named this morning when he asked whether China and the United States could avoid the Thucydides trap. That question was not about tariffs. It was about the deepest structural challenge in international relations, the challenge that has produced war in 12 of 16 historical cases, and that has in every case produced a period of monetary uncertainty in which gold outperformed every other asset class. The second type of investor is watching what I am watching, not the trade headlines, the monetary architecture, the gold to treasury ratio in global central bank reserves, which has crossed a historic threshold. The yuan gold price on the Shanghai Gold Exchange, which tells you what Chinese institutional investors are doing with their domestic savings as their government builds alternative monetary infrastructure. The Federal Reserve's Reserve Management Purchase Program, which is already performing the function of buyer of last resort in a treasury market that is struggling to absorb the volume of debt the American government needs to issue. And the Thucydides Trap framework itself, which tells me that the transition we are inside, the transition that Xi named today in Beijing, is not a temporary geopolitical episode. It is the structural dynamic that will define the monetary system for the next 50 years. In 50 years of studying these cycles, I have watched every major monetary transition from the inside. The investors who understood the structural dynamic before it completed, who positioned themselves in the asset that exists outside both competing monetary systems, consistently preserved and grew their wealth through the uncertainty of the transition. The investors who waited for the transition to complete before acting consistently found that the asset they should have held had already repriced to reflect the new monetary order. The Thucydides trap transition is not complete. The window in which the asset that protects through monetary transitions can be accumulated before it reflects the full structural reality of that transition is open right now. Xi named it this morning. The historical record says what always comes next. Most investors are watching the wrong summit. Now you know which one to watch.